Alright, welcome back everybody. So we're going to continue this video series of the weekly trades, and in this one we're going to talk about buying calls or buying puts. Now, a lot of times, I'm sure you've heard me say that I don't like to swing trade a call or a put. And the reason why is because you're completely exposed to the implied volatility and the crush or the spike that comes with it. So if we're looking at this right here, I want you to very clearly see what happens when price shifts. So at the end of the week, it was on a move up. It had gapped up like the Gilligan's Island play here, right? And look at the implied volatility from Monday and Tuesday. You see this rise in implied volatility. Now, if you were trading puts and you had bought a put on Friday and you were looking to close it out later in the following week, you would have made money. The implied volatility expanded. Think of that expansion like blowing into a balloon. You're blowing up the value of that put. If you bought it, you want that put to gain in value so that when you sell it, you've made money. The problem is, if you are on the wrong side of this, it's going to hurt you, right? So when it gets to the lows and you're thinking, I think this is going to go up, I'm going to buy a call. Okay, so you buy a call, the market doesn't really rip to the upside, but it starts to slow grind up, right? And you're looking at it and you're thinking, this is going great. It's moving up exactly how I want it. But the implied volatility is going down here, guys. Look how much it goes down by Friday. Way lower than where it was last week. And look at price. This is divergence if you've studied any kind of divergence indicators, right? We can call this like a 15 degree. And then we go back here and we look at this, and that's way more than a 15 degree, right? So this crush and volatility down here is sucking all the value out of that call. So the call is making money, it's getting bigger as price goes up, and yet volatility is going down here, and it's deflating the value of that option. So in this price move, that option might have made 75 cents for every dollar of the move, and yet this is running right behind it, knocking another 25 to 30 cents out of that, so that for every dollar move you might see 15 or 20 cents. That sucks. You want to make a dollar to dollar move. You want to get into a market and make as much as you can. And yet here you are getting everything right. You buy a call at the lows, you watch it rip for the next 4 days, and you don't get the money that you deserve because you lost it from volatility crush. So while I'm not totally against trading calls or trading puts, but what I am against is putting on a trade that goes against volatility. We can do it though. I don't want you to think that it can't be done. It absolutely can. And you can make money on it too. This could easily double in value or even triple in value if it was a big enough move. That's the problem though. This didn't make a really big move. All it did was grind back up. It's still within the range, right? It didn't even peak out of the top of the expected move. So if you're looking at a market and you're not expecting one of those Babe Ruth, knock it out of the ballpark, oh my God kind of moves, don't just go grab a call. Put the trade into some kind of spread, even an unlimited upside spread. Those do exist. And that way, as much as it runs, you can make money on the run, and you can still protect yourself from the volatility crush. Of course, if you build the trade the right way, you don't really care how far it runs. You'll just make money from the time passing and from the volatility crushing. In a position like this, you could just buy the call. Absolutely, you could just buy the call and be done with it. Or you could put on a credit spread. You could put on an iron condor, expecting from these lows the price will end the week inside of this box. Just like that. You have choices. And if you did do an iron condor, the crush would help you. It would actually make you get to your goal faster. You wouldn't have to hold this until Friday for that iron condor to hit 50% profit. You more than likely would have been able to close it out on Wednesday, if not sometime on Thursday. That's the whole idea, guys. This vol crush, it can work with you or it can work against you. So in this example, we could buy a call and run it up. We could also sell a put and run it up. Now remember, when you sell a put, you need to be able to buy it back cheaper. If it gets vol crushed, you make the money. Now, I don't recommend anybody go sell naked puts, right? That's just a very bad way to do business. But you can do a spread. You can sell a put and then buy a put, and that puts you in a bullish credit spread, a put spread, and then you accomplish the same goal. You make money as price goes up, and you can build that with a 1-to-1 risk to reward ratio. You could take it right at the money, and that will get you there. So don't mistake me when I say that I'm against trading calls and puts. I'm not. You absolutely can make really good money doing it. But if you're not expecting some absolutely amazing move, think about building the trade in a spread. Even in a really big move, you can see here, this is a hell of a move. From 247, and it finishes the week at 277. That's a $30 move in SPY. $30. That's like a 10% move, guys. That's huge. Look at the vol crush. From 45 down to 41. It's a big crush. I know that don't sound like a very big number, guys, but that's huge. Even in a move like that, if you was just buying calls, you're not going to make as much money. And isn't that what it's about? These calls in this environment are going to be very expensive. It's not like last year around Christmas time when Friday calls were, 80 cents. We're talking about $800 here to get a call. You want to risk $800 and then only make 30 cents on the dollar as it moves? Now, granted, this was a $30 move if you got in at the lows and you got out at the highs. But if you're only making 25 cents on the dollar, every $4 in that move, you made a buck. All right, so guys, that's not very good money. That's a lot of risk. So in the current market environment, with such an elevated implied volatility and such wild swings in the implied volatility, I don't recommend trading just a naked call and a naked put. Now, on the put side, which is what I've been saying for quite a while now, remember, when you buy a put and it gets vol crushed, you will make more money faster. So if you're looking at a downward market, you can't go wrong with just buying a put. You can't. That thing's going to make some serious money, because as the market falls, that put is going to just make so much money so fast. Right? Now, again, here's the problem though. When the market goes down, the implied volatility is supposed to go up. And yet, look here, they crushed that volatility. So, if you were short on this part of the leg, you were killing it. You were just selling puts. You were making money in the price move, and you were making money as the volatility ran higher and higher. But if you started selling puts right here, then you started to get vol crushed. Excuse me, buying puts. If you were buying puts through this, right, you would just make it and bank it right here. But if you were buying puts here, you had the price right, but you got vol crushed. So you better understand what's going on with these market makers. If the volatility is high, then it's going to have extremes. Look at these whiplashes in here. These extreme moves in volatility. That is massive. And for no arbitrary reason that we can see whatsoever, it swapped. It changed over from one to the other. Price was still moving in the same direction. The market makers just started crushing the volatility out of it. If we go back and we look at the way volatility was back in a normal market, look at these. That looks really extreme, right? But we're talking about the low teens here. The low teens. It didn't move very far, right? These are very low values, low swings. So yeah, those were taking some volatility punches, but it wasn't rip your face off kind of volatility. You could get it wrong and still make plenty of money. But right now, this example right here shows just buying puts, and where they should have expanded with volatility, they didn't. Those people got screwed. Well, don't do that. Don't be screwed, right? Shunt that volatility by putting on a spread. Or if you are going to trade the calls and you are going to trade the puts, realize what you're fighting against. Look at the current implied volatility and ask, is it pointed in the right direction? You could see that this started to point in the wrong direction. You had almost a week and a half of it going the wrong way, right? You can see here in the current week that we're about to begin, it's pointing up. Now that's not necessarily indicating that it's going to just go up, right? You can see it was pointing up the previous week also, and then on Monday down it was going. So it's not 100%, but at least look, which way is it trending? Which direction has it been favoring? Is it actually moving in the right direction? When price goes up, you should see volatility go down. When price goes down, you should see volatility go up. When it's not behaving that way, don't take that kind of trade. Stay away from calls and stay away from puts when they're not acting correctly. All right? There's no perfect way to do any of this. We need to be able to recognize the dangers and the warning signs and make the decision based on our understanding of what we know currently at the time. And so if we see 4 days that volatility is moving in the wrong damn direction, then we want to make sure that we just avoid volatility, which means we avoid the call and we avoid the put. You can still put on an unlimited upside trade or unlimited downside trade and not have to worry about getting vol crushed as bad. But I will say that in these near-term trades, you can only block or shunt volatility so much. Even a spread won't protect you when there's only 4 days left or 3 days left or 2 days left. You're going to take a punch from volatility. It just won't be as bad if you build it into a spread. And my main point is, if you're not even looking at it, if you don't even know about it, if you don't think about it, you're screwed. When we do know and we get it wrong, at least we tried, right? We took the effort to go in and try to find a way to block it, to protect ourselves from it. Even if it didn't work, we at least were focused on trying to deal with it. But if you're completely ignorant of it, and you don't even look, and you don't even think about it, you're not going to make it as an options trader. This is something that you have to make a part of your trading. And it's not just for these weekly options. That's for options. You better understand what is going on in the implied volatility market. So for these trades, one thing that I like to do when we were back in a normal market is that when we would get outside of the expected move, or if we tagged the edge of the expected move, I would immediately take it in the other direction. And that worked really well. I won way more than I lost. And remember, these are small trades. Trade small, trade often. In that kind of market, when the volatility was a lot lower, there was times when I would buy a call when markets got down towards the low, and on the second day or on the last day, I would sell a call at that top expected move. All it did is just gave me a little bit more money. All right, I would have that call. I would already have the original call. So I have a call and then I sell a call, right? If you wanted to use a small account and you was just to go try to sell a call, you would probably need permission from the brokers. It would be a naked call. They're not going to let you do that. Same with a put. But if you already have one, if you bought one earlier in the week, and then here you are later in the week trying to sell a call, they will let you do that because you're building a spread. It doesn't matter that you're doing it days later. So this just becomes a really cheap addition. Oftentimes, maybe only $5 or $8, but that $5 or $8 covers my commissions. I'm okay with that. It's just a couple of extra more dollars. One more way to say screw you to the market makers, right? Because they sure screw us often enough. So give it back to them once in a while. Those were fun trades. When you look at something like that on a Thursday and we're still tagging the bottom of the expected move, and you see that the top of the expected move is way up there, take advantage of it. You're just adding a few more dollars to the position, right? Same thing in reverse. If it was early in the week and we came up and tagged the high, I'd buy a put, take it the other direction. And if by Thursday or Friday we were still hanging out nowhere near the other expected move line, then I would go down there and I would sell one. All I'm doing is building a spread. Right? It's really, guys, it's that easy. So that's the calls and the puts. And that's certainly not the only way you can do it. Think about buying a call on a Monday morning and the market just does exactly what you want. And it starts to get up towards those highs. And then on Thursday it starts to fade right back in again. And you begin to realize, oh, you know what? This thing's going to close inside the expected move again. And so you take that call that you had already bought and you turn the whole thing into an iron condor or into a butterfly, that you keep the trades you already had and then you just build options around it. Yeah, you can do that. You absolutely can do that. So many different ways to do things, guys. This would be one of those examples. You can see, say it opened on Monday and it fell to the lows, and on Tuesday you go in and you buy the call, and by Wednesday afternoon everything's looking great and you're thinking, you know, we might actually hit the top of that expected move this week. And then on Friday, what's it do? Just gaps horribly to the downside and starts to struggle its way back up. You can tell it's not going to make it to the top of that expected move. What are you going to do with that? You could sell a call up there, or you could take that trade that you were in and you could build a butterfly. You could build an iron condor around what's left of the position for the week, right? Using that to your advantage. These expected moves, you really want to spend time with these, especially on the indexes. Look at how far price has left to move inside of these ranges and see what you can do with it. You will find a lot of times that the value of these options aren't going to be very much. If say you get it on Monday or Tuesday, on Thursday or Friday, there's not much value left in there. So if you're going to go sell a call or a put on Thursday or Friday, you're not going to get a lot for it. We're talking, 15, $20. But it's almost a promised 15 or $20, right? So take it. Guys, I appreciate your time. I'll look forward to seeing you at the next video.